What's up, guys? Jay Martin here, investor and CEO of Cambridge House. And my guest today is Chris Vermeulen, the founder of The Technical Traders. Now, I love talking to Chris because we invest very, very differently. I am so people-driven in my approach, as anybody who watches this show understands, whereas Chris is completely void of any emotion and any fundamentals. He's strictly a technical trader, but not a high volume like day trader. He makes 3 to 4 trades per year and consistently outperforms the market. So whenever I talk to Chris, I learned a lot. Today, he showed a bunch of charts, explained a bunch of things, essentially how he determines probability of price action based on what he's seeing, and he walks us through some of those today. I hope you learn as much as I did. I thoroughly enjoy talking to this guy. So 3 things before we jump into today's interview. Number 1, right beneath this video, there's a pinned comment where you can subscribe to my weekly newsletter. It's free and I love writing it. Love to have you join the team. Number 2, this YouTube channel now actually generates significant advertising revenue, which is awesome. I'd never expected that. So what I've decided to do with that cash is donate it to an organization that is super close to my heart. They're called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by giving super at-risk urban youth the opportunity to relocate to beautiful wilderness areas, provide them with supportive housing, employment training, and just great influences, right? I was really lucky at a young age. I got to spend a significant amount of time in the natural world, and it transformed me for the better. I love being able to pass this forward. We should all get outside more, right? So that's what Zero Ceiling does, in addition to plenty of other things. Check them out if you're interested. They're awesome. Number 3, if you prefer to listen to my content as opposed to watch it, you can now find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, here's Chris Vermeulen. Enjoy. I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome. All right, guys, Jay Martin here, investor and CEO of Cambridge House, and I'm joined right now by Chris Vermeulen, the founder of The Technical Traders. Chris, it's great to have you back on the show.
Hey, thanks for having me, Jay. Always a pleasure.
Did I pronounce your last name correctly, Vermeulen?
Yep.
Like the worst thing ever when I get that wrong in the first sentence. Hey, look, it's great to have you back, and I'm excited to jump into like a web of directions in this conversation. To start, though, why don't we start here? You know, you're a very different investor than I am. You know, that's why I appreciate your perspective and why I want to have you back on. I'm very sentiment driven. I look at the people, I invest in entrepreneurs, and you cover angles that I don't. So for anybody who hasn't seen our first interview or isn't familiar with The Technical Traders, you know, how do you approach the markets, Chris, and how do you spend your time?
Mm-hmm. Yeah, we're definitely see the markets from a different angle, or we invest in different things for different reasons, which is what makes the market, which is perfect. But I'm pure technical analyst. I don't care about news. I don't look at fundamentals. It's nice when all that stuff's possibly in favor of what we're doing, but really the only way we make money as a trader or investor is if price moves in our favor of the asset that we bought. So I strictly follow price, which means I'm looking for cycles and trends. I'm looking for volume flows. I'm trying to find market leaders. Where is money, the majority of money going on good days, on bad days? And when you can identify what sectors or commodities or even indexes those are, that's where I like to put my money. And when the market's saying buy, I'm in the market. When it's not, I'll either be in bonds potentially to profit if the market's favorable. Sometimes bonds are not a safe haven, or I'll move to cash. So I'm pure technical. Just give me the charts. Doesn't matter if it's cryptos or anything else, really. It's just pure price action. Just show me the chart and I'll be able to kind of navigate through it that way.
You know what I love about that, and this brings me to why I wanted to talk to you today, is that I think our intuition really harms us in the market, right? We're so impacted by so many biases that enter our psyche that we're unaware of, whether it's like hindsight bias, recency bias. You know, we're impacted by the crowd, by the herd. We're herd animals. It's inevitable that we follow people, right?
Yeah.
So talk to me, therefore, where you're seeing value right now based on the charts, because I was having this conversation actually many times in the last 2 weeks about what's undervalued. Where's the good home for capital right now? It's hard to find things, right? Most assets are inflated. So what do you see?
It is. Yeah. So when you say what's undervalued, it kind of goes against, it's tough to find stuff that's undervalued right now. We're kind of in this bubble and you look at inflation, everything is ridiculously, feels like it's overpriced. Hopefully in the future, we see real estate come down. We see everything take a breather for a while, but I think precious metals and miners are kind of undervalued. But the thing is that goes against kind of how I trade because they're in a very strong downtrend. So you look at them, they've been going down for a year and they're still making a series of lower lows and lower highs on the daily chart. So I think they are undervalued, but I don't move into something that's trending down. I'm looking for something that's trending up. So where are some plays that I'm looking at? I mean, I like XHB, which is kind of the home builders sector. It's taken a breather over the last several months, but it's built this beautiful platform. I think it's primed and ready for potentially another big rally. I can actually pull a couple of charts up here and
please
show you real quick.
Please.
Sure. So if we take a look over, let's go over here, take a look at XHB. So this is a daily chart of the market. And more or less, if I was to just zoom out on XHB, you can see it's had some really nice move to the upside. And more recently, it's pulled back. It's had a very nice correction. It's put in what looks to be a technical bottom. And now it's rallying up and it's consolidating. And you could argue here that this pattern is more or less kind of like a cup and handle pattern where it's built this launch pad, this bull flag. And typically this resolves to the upside, a very big move. Now, overall, I mean, it's tough to find a good spot to dump money. I'm pretty cash heavy right now in terms of a lot of speculative money. Because when you look at the market as a whole, like let's take a look at the Russell 2000. So there isn't an easy sector to jump into right now, which is where I'm getting at. When you look at the Russell 2000 for most of this year, it has traded sideways in this big range, just kind of oscillating back and forth. We haven't seen individual sectors, a lot of them really just breaking out and running and making all-time highs. Most of the sectors are actually in a short-term downtrend, which you can see on this table here. Some of them are in a distribution phase, which is like a topping phase, much like the Russell 2000. A lot of them are bearish and they're in downtrends. So there's not a lot of support in this market right now. And what I am looking for before I get really excited for this market is for this Russell 2000 to break out of this range. When it can break out of this huge kind of consolidation phase, whichever way it breaks, it's going to be a big move. If it breaks down, we're probably going to see a much deeper market correction. SP 500 could drop maybe 10, 15% from where we are. It'll be pretty sharp. If the market breaks to the upside, the Russell 2000, then we're like game on. I think we're going to see a blow off top. I think the Russell will rally about 30%. And that's when we get into that 2020 type of market environment where everyone is euphoric. They're chasing prices higher. They don't want to miss out on the next move. If they miss the first one, they're even that much more adamant to buy into this market. And that's when we're going to start to see a lot of sectors come to life. We're seeing a lot of sectors like you look at hack, these patterns on these what were leading sectors last year. They've consolidated, they've rallied up. They're testing some previous highs from early this year. ARC-W, which is the internet. A lot of these are very tech heavy. They've sold off dramatically. They're building a base. Tesla's doing the same thing. I think technology, if the Russell 2000 breaks to the upside, we're going to see a lot of those big tech moves, those sectors that rallied in 2020, take the lead and rocket higher. And so if I was to show you what that would look like on, say, the SP 500, let's just take a look here. This will give you a quick little visual. If we go into this next push with the Russell breaking to the upside, that's where we're going to go into what I think is going to be like a euphoric kind of rally where the SP 500 and the NASDAQ are going to go up really sharp. And then it's going to eventually crack and put in some type of topping phase and start to break down because there's going to be a financial crash eventually. But really, I think a lot of this is hinging on what the Russell 2000 is doing because that's the sentiment of speculative traders, people who want to get into small cap stocks. And if it breaks to the upside, there's going to be so many people saying, I can't take it anymore. I have to get in this market. And we're going to just see the market rally. So I'm really kind of neutral, other than a couple sectors there going forward until we see what these markets are going to do.
And that's how you approach it, right, Chris? You're not going to call the Russell up or down. You're going to wait to see what it starts to do, right, and then follow the trend.
Exactly. Yeah. So you got to let the market do what it's going to do. And you don't like it's a 50-50 bet right here. This is either a major top or it's a major launch pad for it to go a lot higher. And getting in here, the odds are it's going to break to the upside because it is in a bull market. It's in an uptrend. but it's still a really high risk trade. You might as well wait for confirmation and then jump on board with the leading sectors.
So that clarifies for me, as you said, it's a 50-50 bet. Now going back to XHB on that chart, you showed, a sort of a cup and handle and somewhat of a bull flag, correct?
Yeah.
Yeah. Okay. So this leads you to believe, correct me if I misunderstood, Chris. This leads you to believe you're seeing bullish signals in XHB, correct? And
yeah, so it's holding up really well over the last several months compared to most other sectors. So it's a sector that's kind of been leading the way. It's held the best value over most of them. Most of the sectors have pulled back since that market high and are kind of trading down over here. And they're very kind of in a downtrend, but we're seeing XHB is now trending up. It's got a bullish pattern. It's trying to find a support level here to launch from.
And if you were to attach some probability to your thesis, could you do that? Do you do that?
I mean, the odds are it's going to go higher because we're in a long-term trend. I mean, I can't throw an exact number on it, but when the underlying trend is up, the odds are it's going to continue to move higher. So we're really at this really critical turning point right now on the stock market where we're going to know probably within 5 or 6 days or so if we need to actually just get out of the market, because the market is just hanging on by a thread. If we were to look at like the SP 500 here, the last signal to get long was right over here, and it's been in this uptrend, and now we've seen this big gap down, and we're still hanging on. This market is hanging on by a thread. What we're waiting for is a few more technicals to break down. We need some cycles to get out of favor. If the defensive sectors become more active, like utilities, if bonds start to take off, precious metals, that's going to be one of the signs that we need to just close our position and then let the market do what it's going to do. But the market is still on the verge of this being a major standout low, something like we saw over here just before it starts another rally. Mm-hmm. And when you look at this sentiment chart on the the right-hand side, this I've coded in here. This shows us the sentiment of the average investor, of money flow, what everyone is doing. And when we get these red bars, this is when everyone is panicking. This is when they're dumping shares. They're moving into defensive plays. And if you notice, when everyone's panicking and they're scared, we get a huge, very sharp reversal pop after that. And so that's what we've just had in the last few days. And so I'm waiting to see if we're going to get this pop or if this trend is actually stalled and we need to exit. So it's a really critical time. I can't say just jump into any sector because, in a couple of days, this whole game could change and we might actually just be moving to bonds or to cash to be protective.
Yes, this is so interesting to me, Chris, because it's so different from how I approach the market. So I feel like I've got so much to learn here. So, okay, so a couple things here. So first of all, for context, this is September 22nd when Chris says, in 5 or 6 days, depending on when you're watching this interview, it's recorded on September 22nd. Secondly, and again, back to XHB, so I appreciate what you shared there. And once again, you're not looking at any fundamentals, right? You're not looking at any macro trends. You're not looking at any economic data. You're just looking at the chart and projecting what may or may not happen based off of what you see on this, right? No external influence, correct?
Correct. Yeah.
Okay. So now talk to me about defensive sectors and defensive plays. So Russell starts breaking to the downside. You mentioned utilities, you mentioned precious metals, maybe bonds and cash. What else? Where else do you go with your cash, Chris?
Sure. So, there's times when bonds act as a safe haven. There's times when they don't. And they've kicked back into a gear where bonds are now actually a safe haven. If we get a sell signal in the stock market, you don't want to actually generally short the market. If I was to go back and show different trades, every time there's a sell signal in the market, the stock market doesn't really generally drop that much. And when it does, by the time you get a signal, it's dropped too much that there's not enough gain left in it. The way to play a down market goes against what everybody wants to do, which is they all want to trade an inverse ETF and profit from a falling market. The reality is you can go to bonds and actually play a move in bonds. So if we were to just look here at the most recent move in bonds, let's just focus on the hard right edge here. Bonds have gone in a very strong downtrend. They put in a bottoming pattern. Now they've rallied up and they've formed this beautiful bull flag pattern. And really, if you look at TLT, which is the bond ETF, It's broken out of this bull flag pattern. It's pushing up as of today. And I mean, really, this is pointing to a pretty significant move to the upside. And we can get a basic momentum off this move using the low and the high in this recent pullback. This will tell us where this momentum should carry us now that we're starting to break out here. And that move is all the way up to 162.94 for TLT. And I think that's like a 7 or 8% move to the upside. So there's quite a bit of upside potential in bonds. Technically, they're on a buy signal, and they're starting to outperform the stock market. And that is an early warning sign that, hey, this is not what we want to see in terms of us owning equities. If bonds are beating stocks, that's a really bad thing. And if we were to go and look back in time to what happened back during COVID here, you can see the exact same thing started to happen. We had a big bull flag pattern just before COVID. It had a big rally up. It had this flag. It started to break out. We saw bonds rally up. We saw the stock market move higher as well. But bonds are actually outperforming the stock market. And that's what's starting to happen right now. And then eventually the stock market crashed, and then everyone piled into bonds. And bonds had this huge 26% rally. And then they dropped 22% in the next 5 or 6 trading days. I mean, it was a pretty wild ride. But bonds are a place to go right now. They are acting as a safe haven. The trend is up. It's breaking out as of this week. So that is a place to go. And if bonds aren't a safe haven, which sometimes they're not, cash. No one likes to do cash, but I mean, I would much rather hold a whack of cash and just sit there comfortable and happy and not knowing I'm not going to lose 15 or 20% if something crashed. There's nothing wrong with owning cash. You can deploy it. You can use it anytime you want. But when risk is high, why not just hold it, in the bank or your brokerage account and let the market shake things out and be really, just be conservative. I mean, there's no point throwing money at the market just because you want to make more money. Sometimes cash is king.
I love cash. I really appreciate you saying that, because you're right. It's very misunderstood. And sometimes the best trade is patience, isn't it? Right? Sit back and let things happen.
It is. I mean, we played this rally in bonds back during the crash. We caught 20% move in bonds. And then we literally got out on this one day right up here, this huge gap up. It hit all of our targets. And I said, liquidate, this is it. Anytime bonds move 20% or more, it crashes. It's done this over and over and over again. And I got so much flack from subscribers. They're like, why would we get out of it? We're making money. We're winning. I'm like, I mean, statistically, it's going to crash. We hit all of our targets on top of it. Our strategy is saying exit the trade. And of course, if you didn't, you ended up probably getting back out at break even on a wick low, a week and a half later, missing the whole move. So you really have to stick to rules. It's all about managing positions. If you can't manage positions, you'll never make it long-term as a trader. You have to exit, whether it's a winner or a loser. You got to bite the bullet and say, rules are met. I got to do it. And you hit the trigger, curse and swear all you want, but you gotta follow rules, right?
That's it. That's that recency bias coming into play, right? We assume what happened yesterday and the day before is what's going to happen tomorrow, especially because it just adds to our own conviction, right? We thought this was going to happen. It starts occurring. Well, now we feel even smarter because, we're more right than we were yesterday. So why wouldn't we be even more right tomorrow?
Yeah.
It's very blinding.
Exactly. When you feel real good, it's usually the end of something. And when you're really, really scared, it's also usually the end of something. But the emotions are always the opposite of what you need to be doing. It's so tough. My old partner used to say, when you cry, it's time to buy. So when you're in a bloodbath and you can't take it anymore and you're about to exit, he's like, that's when you got to actually buy, right? When you yell, it's time to, what was it? It was something else. I can't remember what it was. Yell something anyways. But yeah.
Okay. Yeah. I love that. It's great because I am quite exposed to the precious metal sector for many of the reasons that I shared at the opening of this interview. I'm like, where can I, as like a sort of, 3 to 5 year time horizon investor, go where I find things are undervalued and it's tough right now. But precious metals equities are one sector that I see as, for whatever reason, very beat up, very hated on. I was chatting with some friends who were at the Denver Gold Show 2 weeks ago, and they're talking to what they described as diehard gold bugs who are telling them that gold narrative is over. Gold is dead, is what they said. And I love it. As somebody who's very exposed to gold equities at this moment, and shopping for more opportunities, that's kind of what I want to hear, right? It's
totally. And it feels like it has been the opposite. I mean, it feels like the last few years, I mean, we're kind of in the precious metals bubble. So it feels like we're always talking precious metals, but it feels like everybody's been in precious metals waiting. And when everybody's already doing that, it's generally not going to move because we're already in, right? And so when you start hearing people give up on it, that's like music to our ears. It's the same with like the uranium sector. I mean, commodities and commodity stocks can go out of favor for 5 or 10 years. And when they're totally off the radar, that's when they come back from the dead. And that's what uranium stocks are doing right now. They've just broke into a new major, like kind of secular bull market. And they've had huge gains, but I think it's like just the tip of the iceberg. And precious metals, I think, are going to come into that phase. Maybe not for another few months. I think we're really close to them finding a bottom. And generally, what we're going to see are precious metals and miners start to rally when they start to outperform the general stock market. That's going to be another warning sign that we're probably seeing the stock market getting closer to one of those big corrections. And I mean, a big correction is in like a 20, 30, 40% correction against something pretty gnarly. It'll be a crisis of some sort. So precious metals are a good warning, but there's lots of upside potential because they tend to take the lead. They see that issue coming, it seems. And that's kind of what we're positioned for, because I think they're like little golden rocket ships when the timing's right.
When the timing's right, if you have the patience and the wherewithal, and I think the cash, the dry powder to know you can act on other opportunities, right? You're not weighed down by positions that may not respond for a year, 2 years, 3 years, 5 years, whatever it is. If you have to exit those positions to take advantage of some other opportunity, you're not going to love them so much, right? But to your point, like, respect cash, keep some, keep that dry powder.
Yeah. Well, I was the golden oil guy for years. I mean, during the whole boom and it was amazing. And then literally they went into bear markets, and it's like, I don't want to trade stuff that's in a bear market. And, people don't like the idea that you're not buying gold stocks all the time and trading the ETFs. When they're not in favor, you're way better to go look at something else, even if it's just trading the index, because it is dead money. I mean, gold and oil, really struggled for so long. Really, just 2019, they finally turned that corner, and now we're in this bullish phase, a secular bull market, and this is just a giant bull flag for gold and gold stocks. When this ends, I mean, we're going a whole lot higher. Gold will be 2,600 next stop once it turns around. That's probably a year out or so, maybe, but it's a very bullish chart, and that's the most conservative upside target I have for gold. I mean, you can stretch it as high as you want basing on what you want to do, but that's a conservative technical target. Like, I think we'll hit that for sure in the future going forward. A lot of it will have to do with the US dollar and what kind of crisis is next.
Sure. Yeah. I'm not so familiar with the oil market, Chris, but quite familiar with the gold sector. And, the issue I see with I guess maybe investors in the gold sector is they fall in love with the asset class, and they become sort of fans of the asset. Not just an investor, but like you become a fan, almost like a sports team. Yeah. And you become a cheerleader for it, right? And it's so blinding. It's like a recipe to get smacked and blindsided. And we see this now in the crypto market, right? People become evangelical about the future of this asset class. And I caution investors, I'm like, never fall in love with the asset. I don't care what it is, right? It doesn't love you back, right? So just pump the brakes on that for a second. Now, what do you see? Because when you're holding a position and prices start to fall, maybe you were just wrong. Maybe you were early. I don't know, right? But there's a part of your brain that can say, the market's wrong. I'm right. The market hasn't recognized it yet. This, and then even more confusing can be, this is what contrarian investing is all about. It's holding on when everybody else is running, right? Now, do you see that mistake made? Because you mentioned your subscribers, you're making money on a trade, you're telling them to get out. They're saying, why? We're making money. And you're saying, because of the chart. Look, statistically, this is going to correct. You must see the same with the downside, where investors are like, no, we just got to hold on. And you're like, no, cut your losses. You're catching a falling knife. Yeah,
you've got to exit trades, and like the contrarian play. I don't really get stuck on the other side, because contrarian plays mean you're going against the trend. You're trying to pick a top or bottom or type of play. And that's not what I do. I'm following the trends. I'll let the trend confirm. I won't get in near the bottom at all, but I'll get in. And then eventually that asset will top. It'll start to sell off and I'll get out. So I won't get out anywhere near the top as well. But it's about catching that center low risk chunk where it's confirmed it's in an uptrend. You ride it up. It confirms it's rolled over and sold off. It's in a downtrend. I'm getting out. How much did I make? Okay. I was up 100, but I ended up pocketing 60 when it's all said and done. That's kind of the reality of trading if you want to stick to rules. And, I've really tried to implement trading rules and trading systems to our newsletter. So people can understand and say, listen, we got to wait. The technicals are going to tell us when we need to change. The sentiment's going to also tell us when we need to change. And anything else beyond those two not meshing together, I mean, you're really just picking a top, or you're really just guessing at it. You're not actually following a technical pattern. You're just going off a bias, a gut feeling. And the gut is what really gets you every time. You're going to get out in and out at the wrong time. And it's usually you sell out and it could pop without you or whatever, but that happens. But that's just part of trading. And people don't understand. It's all about a whole bunch of 1 and 2 base hits. It's not a bunch of grand slams. And so people want that big money, and they want it fast, and they think they should be trading all the time. And I go the opposite. I'm all about trading as efficient as possible. So I focus on ETFs, and I've got an index and bond trading strategy that is, to me, it's the most efficient way you can potentially trade this market. It's the fewest trades, it's the smallest drawdowns, and we completely annihilate the SP 500 and the NASDAQ with 3 or 4 or 5 trades a year, just playing cycles in the market, using all the tools that we have. And that's my goal, is the fewer trades I have to do, the better. So the less you're risking. We're sitting in cash about 3 months of the year, every year, like clockwork. There's just times when you don't need to be. Just like day traders know there's certain days of the week they don't trade, certain times of the day they don't trade. Well, investors should also say, hey, there's quarters or months that I shouldn't trade. But people don't look that far and go into that. But it's those little details. The devil's always in the details. When should you just be like stepping aside and doing something with your kids, right?
Yeah.
And my strategies are generally end of day. So I get confirmation when the market closes, and I don't need to be glued to the screen every day. I can be like, hey, okay, market's closed. Everything's confirmed. Tomorrow we get into this, or tomorrow we get out of this. And so it's very passive. It's kind of like, it's like an active investor or like a really lazy trader. And that's a nice thing. You can kind of just tack it on to whatever trading you're doing, but you can add alpha with a few trades a year just on the SP 500 ETF and on the TLT. Usually we're in one or the other. Sometimes we're in cash. So that's kind of my real core focus, because I don't want to be glued to the computer every day.
Love that. Oh man, okay, lots of gems in there. And I just want to call back on something you said earlier. It's about 1 and 2 base hits. It's so important, right? Because far too many people look at the market as a get rich quick scheme, and it's way more frequently a go broke fast scheme or a get rich slow scheme, but it's all about those 1 and 2 base hits, right?
Yeah.
That's like good life advice. We so frequently, I get so obsessed about like the progress I made yesterday and tomorrow and today, and it drives me crazy. And when I'm able to step back and be like, okay, let's look at the year trajectory of your life. You're doing all right. Let's just pump the brakes here on the anxiety for a second. Hard to do. Okay, so that's good context. You're not a high volume trader, as you said, 3 to 4 trades a year, right?
Yeah.
Okay. Now, a question for you, Chris. When did you become that kind of investor? If you think back to when you entered the market, right? Because a process I see a lot of new investors go through is they need to discover what kind of investor they are, right? And until you know that, it's pain you have to go through, right?
Everyone does. Yeah.
Everybody does. So when did you discover what kind of investor trader you are?
I mean, it's a learning curve. I started back in when I was 16. I was like back in 97, and I ended up blowing up 3 accounts over time. I went through a couple of bull markets. I went through a bull market, a bear market, and then super gun shy in the next bull market. And really, 2011 is when I decided to stick with build out my trading rules so they're super defined, like just a checklist, right? Now I'm all automated. Everything's built into robots. But back then it was like create your to-do list, your checklist, follow the rules. And that was like a huge, huge turning point because now you're not searching for a trade every day. You don't feel like you need to be at the computer because you've filtered, you've found your trades. You can follow them. So 2011 was when I really switched from being discretionary, like really discretionary, just finding a stock and then trading it. And every week it was different, to being like, okay, I'm going to trade the SP 500. I want to trade bonds. And those are my baby. If I know what the SP 500 is doing, this is one thing I think a lot of people may not understand is if you don't follow what the index is doing, which is the tide, it's going up or down, it's really tough to trade individual stocks because the way it works is if the stock market is trending up, it's favorable. That's when you want to own stocks. When it is sideways or trending down, you actually want to step back and not own any stocks. But people are totally blind. They ignore the index and they just follow their stocks that they're in love with. And they don't realize that, they just had like a whole bunch of winning trades with their stocks, but the stock market just changed direction and they shouldn't take any more trades, even though they're on a roll. They should actually step back and go, how do I profit from a market that's now going sideways or down, which would be like trade options, like sell or write options. So you can just profit from time decay, which we do. Or you look to bonds. And I mean, the reality is you really shouldn't mess with inverse ETFs because again, most of the time by the time the market's turned around and it's confirmed in a downtrend, there's only like 3 or 4% usually at most to the downside. Very rarely do we get a market crash like COVID that you can actually profit from shorting. That's super rare. Every couple of years it happens and you got to be on it. And then you got to be willing to get short when the market's already fallen, 8 or 12 or 15%. And you're going to hope and pray you get a quick follow through and you can get out. So trading short side is really tough. Inverse ETFs, I almost feel kind of should be ignored, which I'll probably get my head sliced off for that. But, cash and bonds are amazing opportunity to profit from a sideways or falling market because bonds typically move up while the market's going sideways or down. And it's a great spot to park cash. It's a great spot to actually make a lot of money. Sometimes bonds rally 7 or 20 or 25%. And it happens all the time, actually. So, yeah, 2011 was, to answer your question, is when I became very strict. I blew up my third trading account, which I was too scared to tell my wife back then. We've been together like 17 years already. Yeah. But that was it. That was when you hit the straw. You're like, you almost want to just knock yourself out. You're like, I have to follow rules. How can I, back then you start trading and then you start over trading, like day trading and trying to double up and triple down and quadruple down, hoping you're going to get that bounce. And in one day you can blow your whole account up, trading futures. Yeah. And that's what happened on my last one. And I've gone through the cycle of trading all kinds of different assets and styles. As you said, you need to learn who you are. So I started in college and I was trading stocks. I made a fortune on Palm Pilot. It was my first stock I ever bought. And then I ended up taking a course and then I learned to do covered calls. So I started doing covered calls during a bull market, which was amazing. I mean, you just pretty much make 7 to 15% every month because the stock's gone up. You got the premium for the covered call. I eventually got into currencies, and then ETFs weren't very big back then at all. There's only a few. I kind of got into futures, and then the futures is where it's so leveraged, your emotions take over until you blow up an account. Right. It's just crazy. And that was the tipping point really for, smartening up and trading a smaller account and forcing myself to grow it. And it's all about base hits. No more of these grand slam swings like, Happy Gilmore swing. You just kind of chip your way to wealth is kind of the way I look at it.
It's so important though. And scar tissue is so important. Right. To be in this market and to have been blown up. You can't replace that experience with anything. There's no book, mentor, podcast that's going to teach you what it's like to have that impending sense of doom when you realized the scale of the mistake you've made and the consequences you're going to have to now deal with, right? Whatever cleanup that looks like. Right?
You really do. If only all traders could hit bottom really quick and early in their life and get that experience.
Yeah.
Because that's what you need, is that like, oh my God, this is my last attempt. I can't do this again. I cannot just, make money just vanish out of my account and clear it out. If you can hit bottom somehow and realize that you got to have some rules, you got to be strict. It's really tough, but trading is a tough game. I mean, it's a sport, it's a game, it's a business. It's everything blended into one. It's like a casino. I mean, technical analysis puts the odds in your favor. You become the house, thank God. But you got to be real strict and follow those rules, or the house, you're not the house anymore.
No, and our brains are incredibly compelling. Our emotions are incredibly compelling, and until you've had to manage the seductive greed of a rising share price, right? Or the skull crushing anxiety of a falling one in a position you didn't get out of in time. I love your quote. Should we all be so lucky, Chris, to hit rock bottom? That's the invaluable.
It is priceless. It can save you so much money if you can just hit it once early on.
Yeah. All right. Look, it's been awesome having you back on and catching up. And I feel like I learned so much when I have you on, because like I said, you look at things so differently than I do. And I really appreciate that. So thank you, Chris. It's been great. And I'd love to do it again soon.
Great. Sounds great, Jay. Thanks for having me. That was a lot of fun.
Okay, guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. But coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational, and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The Jay Martin Show.